Welcome to TMS Insights. Jeremy and Ben here for a December update for you. And Ben, this has been really quite a crazy year for markets, but it was a fantastic November where markets, particularly the ASX, had a really good time. It was up a massive 6% during the month. So a lot of the ills of the challenges of the year have been wiped away in a very, very strong performance.
Yeah, and I think really driven by the blue chip shares in Australia, the resource stocks, the banks have held up very well going into the end of the year. But as you always find, Jeremy, it's at times of peak concern that you get those runs, and it's just, I guess, another reminder that you got to stay the course with shares, and that when everyone's screaming at you to sell, and October felt like a time when you did want to do that, that's when you miss out on the best returns. And in fact, that can make the difference between having a reasonable year and having a pretty average year.
It's probably worth spending a bit of time on that and just saying, how experienced investors over time, you know that there will be periods where they're going to have market sell-offs, and how are you going to react to that? And you've got to prepare the psyche for that. Obviously, the best thing to do is to be able to take advantage and buy well. And often people say it's when they feel really sick in the guts when you get the best returns when you buy.
Yeah.
But investor psychology is not that simple sometimes, is it? And it actually needs to be played out well in advance to know how you can actually act in that environment.
Yeah, I think that's definitely true. I mean, even for us coming in, sort of every day, I think we all know how we should be behaving, but actually practicing that during those periods is really hard. You do see, in the really strong periods, people can get carried away and they start looking at tips someone gave them on a golf course and that sort of thing. And during those really nasty periods, everything's telling you this is just all too hard, and I need to sell because it feels like that's the right thing to do. And it's probably, I think, the way I've always thought about it's trying to not look at the day-to-day or the week-to-week movements too closely, because it'll just do your head in if you do. And trying to look through it, and it's having a plan and sticking to that plan. I think that's the most important thing.
And experience should help you do that. That's the thing. But like you said, I mean, if you're looking at yesterday's results in today's paper, you're not going to have any idea of what the future is going to look like. That's the hardest bit of information to get. But it's what we actually now want to turn ourselves to, because it's what everybody needs to know. This has clearly been a year of interest rate tightenings, which has affected equities, has affected bonds.
Affected every asset class.
Yeah. And it's swung around recently. The next year should not have as many forces against it.
No.
Through the first half of the year, certainly, and probably not through the whole year.
Yeah, I completely agree. I think if I was sort of predicting one thing for 2023, it's that we are very close or at the peak of the rate cycle. And even if there's a bit more to go, the bond market's already factoring that in, so that's not going to be unexpected. And I think investor intention turns from what interest rates are, where they're going to get to and how quickly, and all that stuff we've been talking about on these videos all year, to what earnings are going to do. Because what we've seen is the mini results season we've had recently, I'd give a big tick. The AGM updates that we've seen recently, big tick. And I think that's one of the reasons you've seen this surge in November is nearly all of our companies are coming out and saying what we told you to expect, we're still on track for. Earnings are holding up.
Even though the market's basic presumption was it wouldn't hold up.
Right.
And it goes back to what I often say to people, Ben, is, there's two things: what we know and what we think and what we guess about a little bit. And the predominant guess was the economies are turning sour and these rates are really hurting. And what we're seeing now is there could be a really thin line that the central bank and governments are running where we don't hit recession, we get a readjustment back in rates, but profits continue at a reasonable level. And then the panic's overdone. And the environment's solid. It's not a ridiculous tearaway bull market.
No.
But it's that environment where solid returns are really quite possible.
Yeah, absolutely. I think you got to. The reality is that even if the interest rate cycle has peaked, we're now at a very different interest rate setting to where we were a year ago.
Yeah.
And so the share prices that we saw in some area of the markets a year ago are not going to be replicated even if the rate cycle's peaked.
No, and let's be specific. You're talking about more at the high growth end where the PEs were very lofty in that regard. But I would add that two things. One, it's important to realise that the exceptional period was the period of the last 2 years with really low rates.
Yeah.
And that part's unlikely to be repeated in the same way. But equally, had the share market been priced on that 0.1% cash rate that we dealt with for virtually 2 years, in my opinion, the index would have been more like 8,000.
Oh,
it never actually
reflected the cash
It never
rate.
Reflected that. So don't run away. I think it's important to think that it's all hell in a handbasket because we're no longer at 0.1. That's not sustainable.
Yeah.
And if it was, really, the market would have been well above 8,000.
Yeah. And I think the RBA might be on hold in 2023, and a 3% interest rate is a normal interest rate. What unnerved the market all of this year was the speed at which we went up, and the fact that the central banks were telling us up till March that they weren't going to put rates up. So it was unexpected as well.
And it will affect certain parts of the economy.
Yep. Whether
it's mortgagees or otherwise in more pronounced ways than others, but the overall economic impact won't be great because, as you said, 3% is actually still stimulatory.
Yeah.
The reality is that's not pure tightening. It's just tightening from where it was.
Yeah.
Coming into the new year, just the information flows. I mean, we obviously, this will come to clients after the RBA decision this afternoon. They won't meet in January. They meet again in February. February's reporting season for the Australian companies. That really becomes our focus when the new year begins.
Absolutely. And the reason I think 2023 is probably going to be a less volatile year than the year we've had, and it might be a better year than many are expecting, is because I think you're going to see reconfirmation in February that earnings are still growing pretty nicely. You can very quickly forget that last financial year was one of the strongest years of earnings growth on the ASX in recent history. Yep. And although CEOs have been deliberately conservative in terms of outlooks and guidance and all of those sort of things, the AGM season has given me confidence that pretty much all of the companies we own, the share prices have got cheaper because the earnings are holding up. When you worry is when a company comes out and says, "Oh, we said 15% growth, it's going to be more like 5%," and then you think, "Okay, well, the share price is down 20%, but actually it's now actually only 10% cheaper."
Yeah.
And the first downgrade's normally followed by another. So, I think there are other areas of the market, kind of like the property trust area, I think looks interesting. Like there's still areas that are really out of favour, and where investors are sort of pricing in a pretty nasty outcome coming, and that might not be as nasty as expected, and that the unloved sort of areas might have a pretty good 23.
Yeah, that's right. A little bit of reversion back from what the opposite of what has just happened, rather than extrapolation of what's happened, almost mean reversion as we call it. So, okay. No big bold predictions for you for the new year?
No. What about you?
Oh, look, I just think, the good run you've seen in things like commodities may not be able to continue apace. I think we'll actually probably in December through January have a bit of the volatility that might be the end of that big volatile stage.
Yep.
And then we might see more normalised, steadier markets through 23. So, and again, I think that the basis for incremental returns are very good there. So I think it'll be a good year. I do think asset allocation will become important again.
Yep.
And that's really going to be an area of focus for us. But from TMS perspective overall, we'll have staff on throughout the holiday period on all the business days. Obviously a few less than normal, and it does get a bit quiet over the end of December and into early January. So, but I think really, Ben, on behalf of all the team here at TMS, it's been a challenging but ultimately successful year, and we thank all our clients and our supporters and friends for their support during the year, and wish them all a great Christmas and a very happy 23.
Absolutely. Couldn't have put it better.
Look forward to seeing you in 23.